All right. Chapter 7, Section 3. Personal income tax. Everybody, this is a perfect time for this section because everybody in here that has a job, or everybody's parents in here that have a job, is going to have to pay personal income tax by April 15th. So if I show you how to do it, everybody in here, I can even maybe give you a day in class to do it yourself. You bring all your stuff, okay? You can file your taxes online after this section, if you understand, okay? 50% of the government's income comes from personal income taxes, okay? From federal or corporate and personal income taxes, okay? A business has to pay taxes on what they make, as well as a person has to pay taxes on what they make. Who collects those taxes? The IRS, the Internal Revenue Service. This is just a government organization, okay, that is responsible to collect taxes from individuals and businesses. Four steps into preparing your income tax. Step number 1, find your adjusted gross income, or also known as AGI. Okay. Step number 2, find your taxable income. Step number 3, find the tax. Step number 4, then you just have to check to see if you get a refund for what you've paid already, or if you have to pay to the government. You have paid enough from your withholdings that your employer kept. Adjusted gross income, or AGI. Okay. What is AGI? Well, it's your total income minus certain adjustments. Okay, your total income minus certain adjustments. Well, what do I mean? In order to find AGI, you add all the amounts from your W-2s or 1099s. Okay, now, also any other income that you've had. Okay, dividends, capital gains, unemployment. So if you claimed unemployment in 2011, you have to claim that. Okay, as income, which it is income.
None of us work enough to claim unemployment, do we?
No, you have to apply that. Unemployment, tips, and other employee compensation. So basically, any income that you made, you have to claim. Okay? Any income you made, you have to claim. Then, when you add all that income up, you then get to subtract out. Where's my scroll down? There it is. You also get to subtract out any money that you contributed to a regular IRA account. IRA account is a retirement account. Okay? Now, why do you get to subtract your retirement account money? Because of this. Okay? When you retire, or when I retire, I'm going to pull money out from my retirement account. Okay? I'm going to get a check every month, or a check every 2 weeks, or whatever the rule is. Okay? Or check a year, and then just put it in a checking account. I'm going to draw money from my retirement account. When I do that, I have to pay taxes on that money. That's income. The government's just saying you don't have to pay taxes on it twice. When you put it in, we're not going to make you pay taxes on it, but when you take it out, we're going to make you pay taxes on it. Does that make sense? So basically they're saying, okay, we're not going to make you pay taxes on it because you put it in a retirement account, but after it gains all that money, we're going to make you pay taxes on it. Now, why would they do that? Well, you want to do that, and so does the government, because basically you're taking your money and you're investing it. It's going to make money, so it's going to make back taxes. It's going to pay for itself. Okay, does that make sense? Okay, you put money in a stock. Okay, it makes money after 50 years. Okay, then after it makes money, you get to pay taxes on it. Well, that money just made its own money. Okay, and the government says, well, if you put that money in there, it'll make more money, and we'll get more taxes. Okay, so it's a win-win situation. And you also do not have to pay taxes on alimony payments. Okay? Because here's why. Because if you pay that alimony, the person who got the alimony has to pay taxes on it. So they're saying, okay, you don't have to pay it twice. It's not going to get taxed twice. W-2, what is a W-2? A W-2 is a form that your employer sends you, and it shows all the wages you've been paid, all the federal income tax that's been withheld, the Social Security, the Medicare, And it also includes any required state or local taxes that have been withheld, okay, that they collected for you and mailed in. A 1099 is a form, okay, that gets sent that shows you any income you received on dividends, okay, self-employment, interest. Okay, so basically if you're pulling from a retirement account, every year your retirement account company is going to send you a 1099 showing you how much money you received that year on income. Okay? These forms, I believe that it's the law that these companies have to have their forms postmarked by January 31st. Okay? If they're not postmarked by January 31st, they can incur a fine. Okay, so if your boss doesn't send you your W-2, they can get in trouble if it's not to you by January, or if it's not postmarked by January 31st. Okay? A lot of people will start getting theirs within the, actually right now, what is it, January 11th? You'll start getting yours in the next 3 weeks, is when people start getting their W-2s and 1099s. Okay, if you work for a really large company, usually it takes a little longer, unless they have a good tax service. Okay? 1099s, W-2s, forms that tell you how much money you've made. Now we're going to talk about how to find AGI, now that we know what all this stuff is. If you open up your books, do me a favor, open up your books to page 259, I think? 259. Yes, 259. On page 259, you'll see an example of a W-2 and a 1099. In this example that we're doing on the board, this is actually an example of, or the W-2 on page 259 is actually the example that I'm showing you right here. If you look at that, the W-2 on that page, that's Jennifer Crumb's W-2. Well, Jennifer Crumb earned $24,738.41. Look at her W-2 in box number 1, $24,738.41. Okay, that's where she got that money, or that number. Okay, then she also earned $1,624.01 in interest from her credit union. Look down at the 1099 that she got. 1099 INT, 1099 interest is what it means. If you look at box number 1, it tells you she earned $1,624.01. Okay, on her 1099, her interest form, and that's where she got that number. Okay, she has to find adjusted gross income. We're going to have to add those together. Then she also contributed $1,500 in her IRA contributions. Okay, so in order to find AGI, we have to add together our income. Step 1, if you look at step 1 of how to find AGI, okay, you have to add together your income. So I'm going to take $24,738.41 and add it to $1,624.01. Now, I'm not done yet. Step 2 says I have to subtract out any IRA contributions or alimony payments. So in step 2, subtract out that $1,500 contribution. You do not have to pay taxes on it right now. When you take it out, you do. Whoever takes it out has to pay taxes on it. So your adjusted gross income is $24,862.42. Now that is not the same thing as taxable income. That is the adjusted gross income. They're two completely different things. Okay, we're going to talk about taxable income next. Before you find taxable income, you get to take out deductions and exemptions. Okay, deductions and exemptions, and we're going to talk about deductions first. Okay, we're going to talk about deductions first. So if you look at the next or the bottom of the page, it starts deductions. Now, when we talk about taking out deductions, you can take out the higher of the two. Either you can take out standard deduction or itemized deduction, whichever one's larger. Okay? You might say, well, what are both of them? Well, let's start with standard deduction. What is the 2011 standard deduction rate? Now, this is different from your book because your book was printed, I believe, in 2009. So their standard deduction is different. It changes every year. Okay? I went directly to the IRS website, irs.gov. Okay? And I copied this table into my notes. This comes from the IRS. It says, your standard deduction for 2011, if you're single or married filing separately, so for me, if I file my separate tax return for my husband, okay, if I file it separately, then we both can take a standard deduction of $5,800. So we can take that AGI, adjusted gross income, and subtract $5,800 and don't have to pay taxes on it. Okay? Or if we're married and filing jointly, or if you're a qualifying widower, okay, with a dependent child, then you can take out $11,600. Well, if you think about it, a married filing jointly is two people. It's just doubles $5,800. Okay, so instead of just taking $5,800, you just double it. You get to take out $11,600. If you can claim head of household, and head of household is something that you'll have to look up if you think you can claim head of household. I'll give you a general idea of it, okay, in a little bit. But if you can claim head of household, you can take a standard deduction of $8,500. Okay, and I'll explain that in a minute.
Just numbers. I like how it said you can't use a chart if you're blind. How would you use it anyway?
Wait, oh! I'm glad you saw that. Okay, if you read the top there, it says if you are married filing a separate return and your spouse itemizes deductions, or if you are a dual status alien, you cannot take the standard deduction even if you were born before January 2nd, 1947, or if you are blind. For some reason, blind people and people over 65 get to take separate deductions out. Okay? They get a complete different set of deductions, a complete different table. Like if you go to the IRS website, which I think it's actually still up on my computer. Let me see if I can find it. No, it's not. But if you're blind, you get a separate deduction. You get a different deduction. I don't know why I don't know what the reason is for that. Deaf people don't get the same deduction that blind people do. I don't understand why, but you actually get to take more out of your taxes. I don't know why. Maybe they think blind is worse than being deaf. I don't know. But I don't know what the reason is for that, but I do know that. Do not use this chart if you were born before this, or if you were blind, or if someone else can claim you. Now, you cannot do this if somebody else can claim you, okay? Or your spouse is filing jointly. Is a dependent. Now, itemized deductions, okay? So suppose that you don't take the standard deduction, okay, because you want to take an itemized deduction, okay? Suppose that you don't have medical insurance and you had to get a life flight. You had to life flight someone, or you had to life flight yourself. You had to pay for it, okay? And the total bill for that was $15,000. You had to cough up $15,000 in medical expenses. Well, guess what? $15,000 is a lot bigger than $5,000. What was it? 380, whatever it was. Okay, so you would want to do itemized deductions because of your humongous medical expense. Medical and dental expenses that you pay out of pocket. This does not include any expenses that your insurance company pays. Anything that you have to pay out of pocket is a medical or dental expense. Okay?
Does an insurance company cover a life flight? Do they really?
Mm-hmm.
That's cool.
Yeah, usually. Usually insurance companies will cover a life flight. Now, that just depends on what insurance you have. Yes. Okay? I believe they'll cover it. I mean, if it means life or death, they'll cover it. Taxes. So suppose that you had to pay taxes the year before. In 2011, I had to pay taxes because I didn't collect enough in 2010. You can write that off your next year. You can, because the government's saying, okay, you don't have to pay taxes on money you paid to us. Okay, so they're saying any taxes that you paid in 2011, you can write off. Okay, so income tax from the year before, January 15th, you had to pay $1,000 on 2011 for 2010 taxes, you can write it off. Okay, so if you have to pay this year, you can write that off next year. Does that make sense? Yeah. Okay, contribution or interest, any interest that you paid, not earned. Okay, so suppose that you own a house and you're paying interest on the house. Most house loans, okay, are government loans, okay? So you don't have to pay taxes on any interest that you paid on that. Okay, any interest you pay, you do not have to pay tax. So every year, since I own a house, the bank sends me, or the bank owns my house, I guess I should say, okay, the bank sends me a little receipt that says this is the amount of interest you paid in 2011, and I get to write it off my taxes, okay? Or my student loans, my government student loans, they also send me a receipt that says, okay, in your student loans, your government student loans, you paid this amount in interest, you do not have to pay taxes on that. I can deduct that, okay? So, usually if you have that, they'll send you a form. You don't have to keep that. Okay, you just wait for your form, grab it, keep it on a pile of your tax stuff. Contributions to qualifying charities. Okay, if you go to church and you give a tithe or an offering or whatever your church calls it, you can write that off. Okay, some churches, if you put an envelope, put your name on it, okay, they'll actually send you a receipt at the end of the year that's saying this is the amount that you gave in 2011, you can write that off your taxes, okay, as proof so that the government can't say, well, you just made that number up. Okay, then you have proof. You say, no, I gave this to the church. The church gave me this receipt. A lot of times people write checks, okay, that way they have a copy of what they contributed to the company. That way there's a check. If you donate cash, okay, and you write on your taxes, you're getting a little bit iffy because if the government says, well, we don't have any track record, we don't think you gave that, okay, you have record. Hey, look, I wrote a check out to the church or to the whatever, okay, you can see it, okay. A lot of times in December is when people make large contributions. Why would that be? Why would people make large contributions in December? What? I mean, yeah, well, I mean, large contributions to charities. Why do people make large contributions to, like, the Red Cross, Red Shield, to churches, to, I know,
Christmas time and they're donating.
Why do they donate money in Christmas time? Taxes. What would be the reason? You can write it off. If they have a huge income in 2011, if you have a rich person with a lot of money, and they're going to have to pay a lot in taxes, they're like, gosh, I would rather give this money to a charity than have to pay all this tax on it. So they may give $50,000 or however. I think there's a limit on how much you can give. But in December they'll be like, man, I have all this money, I don't want to pay taxes on it. If I give a contribution, I don't have to pay taxes on it. Well, I mean, you don't give it all to the government, but they don't have to pay taxes on it. If they ship it, they have to pay less taxes. Does that make sense? Okay. So a lot of times over Christmas time, you get a lot of people make donations. One, because it's Christmas time. Two, because they can write it off still for 2011. Okay. You'll see people with companies. They'll start buying equipment. They'll buy cars. They'll buy stuff so they can write it off. So that if their company did really well in 2011, like, gosh, I don't want to pay taxes on all this income that my company made. Let's go buy a truck, company truck. They'll go buy a company truck. Get to write it off. Okay. Things that you use for your business. That's corporate. This is just individual. Okay. You can't write off a car for your personal use. Only for your company. Miscellaneous deductions, only deductions that exceed 2% of the taxpayer's AGI. Okay, and those types of deductions you can look up. Okay, for me they would be, I'm a teacher, expenses that I incur for my school. Like things that I buy for my classroom, I can write off.
So you could buy us all pencils and then write it on.
You're right. Good.
So you want to.
Okay, exemptions. Exemptions. Now, when you took out the deductions, you're going to take the higher of the standard deduction or the higher of the itemized deduction. After you take that out, then you have to take exemptions. Well, exemptions is basically, it's all determined on dependents. Now, here's the definition of head of household. It's an unmarried person who provides a home for other people, such as a dependent child or a dependent parent. Suppose you have a house and you let your mom live in it, okay, because your dad died and she's alone and she wants a place to stay, you can claim head of household. Or suppose your sister or brother or somebody you know died in a car crash or had an unfortunate accident and you are taking care of their child, you can claim head of household. Okay, that child lives with you, you're taking care of it, you can claim head of household. Okay, that's what head of household is. You can also claim yourself if no one else claims you. If your parents claim you, you can't claim yourself. That's fraud. Okay, don't get caught. If your parent, you need to find out when you do your taxes, Mom, are you going to claim me this year on taxes? Okay, if she is or he is, you can't claim yourself. You can't say, oh, well, Mom's claimed me and I claim me. No, you have to put 0. Okay? My mom used to say, if you're living in my house, I claim you. Okay? If you're living in my house, I claim you. When you move out, pay for your own stuff, you can claim yourself. Okay? That was our rule at home. You can make your own rule. But usually, also what we would do too, after I moved out, she would say, well, if you let me claim you, if I make more, I'll give you the difference of what I get, what I get back. Because a lot of times I wouldn't get back as much as she would, or she would get back more. We used to just figure out who would get more back, and that person would claim me. Okay, you can do that too if you have parents that are willing to do that. Okay, it just depends. That's yourself. I can claim myself because my mom and dad, I'm married. I know they can no longer claim me. I'm almost 30. They can't claim me. Okay, but if you're in college, they can still claim me. Okay, myself, my spouse, I can claim my husband. Okay, and my kids. Now, here's something you need to know about kids. Okay, I had my kids in February. I did not get to claim them until they were 1.5. You only get to claim them in the year that they're born. So, for instance, I've had my kid. I had him on February 28th. This is the first year I get to claim him, and he'll be 1. Okay, I get to claim him for 2011. I didn't get to claim him in 2010. Okay, the year they're born. That's why they call December 31st babies tax write-offs, basically. Okay, if you have somebody that's due on January 1st, try to push that thing out December 31st, because let me tell you, you can have it December 31st, you get to write off $3,700 for that extra hour or whatever. Okay, do I have any December babies in here? Anybody born in December? Nobody? Okay, those December babies are pretty much tax write-offs. Tax people like December babies. Okay, because you can write them off your taxes.
Yeah, December, because we worked for 12.
Okay.
You were forced out.
Exemptions. I went to the IRS website and I copied this table to figure out what the exemptions are this year. This year, you can deduct $3,700 for each exemption that you claim in 2011. So for me, I claim myself, my husband, my 2 kids, so I get to multiply that by 4. Okay, now I can subtract that number from the number that I had after I did my standard deductions. Then I get to subtract out my exemptions. Okay, so I get to subtract that number times 4. Now, in your book, it's different because this book was printed in 08, I think, or 09. Okay, so make sure when you do your homework, you use whatever the book says. And I think in the book, it's 3,400. So when you do your homework, use 3,400, not 3,700. Okay? Standard deductions are different, and I'll show you that in a minute. Now, your homework is going to be right here, and I'm going to do number 7 for you. Number 1 through 6 are pretty easy, and then number 7 gets a little tricky. Okay? In 7 through 18, I only want you to try to find the taxable income. Tomorrow, we're going to take 7 through 18, and we're going to find the amount of tax owed. Okay, but we're only doing half of this section today. So, 1 through 18, only taxable income. I'm going to show you what I mean by that right now. Look at number 7, open up your books and look at number 7. Number 7, R. Rodriguez. Okay, if you read your directions, I'll read those first. Find the amount of taxable income and the tax for each of the following. You do not need to find the tax, just the taxable income. Use the tax rate schedule in 7.4. You don't need to use that. The letter following the name indicates marital status. So if you see an S after the person's name, they're single. If you see an M, they're married. If you see a head of household, they're just head of household. Assume all married people are filing jointly and round all figures to the nearest dollar. Okay, so number 7, R. Rodriguez, S, which means single. Number of exemptions is 1. He gets to claim himself. His adjusted gross income is $32,400, and his total itemized deductions are $2,398. Okay, so I start with in order to find my in order to find my taxable income, I start with my adjusted gross income, which was $32,400. Okay. Now, first thing you subtract is your deductions. Well, what were his deductions? Right, is that higher or lower than the standard deduction?
Lower.
Lower, so which one does he want to take? Standard. He wants to take more out, so he doesn't have to pay tax on it. So if you look on page 260, okay, we're not going to use 2011, we're going to use the books. That way we have the same answers as the book. Okay, on page 260, on the little blue box there on the bottom, how much what is the standard deduction amount for single taxpayers? 5,350. That's larger. That's less money I have to pay taxes on, so that's what you're going to take out. Now, if the itemized deductions is larger than the standard deduction, you want to take itemized deductions out. If standard deductions is larger, you want to take standard deduction out. You want to take the larger of the two, the less taxes you have to pay. So I did that. I took $32,400, which is my AGI. I took out my standard deduction because it was larger. And my adjusted is $27,050. Now, am I done?
Nope.
What do I have to take out next? Exemptions. Right. He has how many exemptions?
1.
1. And if you look at the bottom of page 260, in the last 2 sentences, it says, the deduction for personal exemptions is $3,400 times the number of exemptions. So you take that $3,400, multiply it by 1, because he only has 1 exemption, and you subtract that from $27,050. That is your taxable income. That's what the amount of money you have to pay taxes on. So I took $27,050, subtracted $3,400, and got $23,650. Tomorrow, I'm going to show you how to find how much tax you owe if that's the money, if that's your taxable income.
And we're supposed to do 1 through what? 1 through 18.
1 through 18. But in 7 through 18, this is all you have to find, the taxable income. Tomorrow, we'll find the amount of
I got
tax.
one.
Here, it's right there. Go ahead and get started on your homework. And that's it for today.